equity analyst that's going to highlight some numbers for us. And then Sean's going to take us through the technicals, and then you're more than welcome to ask questions. You can just switch on your mic and ask the question outright, or you can type it to us in the chat. I actually got a question in the chat already that Skulk asked. He couldn't attend today, but he asked that I do ask that to Matt once we've finished with the presentation. So without further ado, thank you, Matt. Over to you.
Thanks, Cyril, and thanks everyone for joining us. I love chatting about Naspers and Prosus. It's my favorite stock to cover on the JSE. Today we'll be chatting about the FY24 results. Those came out on Monday. So the big takeaways from the results are that the e-commerce portfolio did quite well. It did well because of growth, scale, and cost reductions. However, it still made an operating loss, but the operating loss did narrow. And then the big contributors, which come from Tencent, and sales of Tencent were much lower than in the prior year. We have made some intrinsic value changes, and those have been driven by a higher Tencent valuation, the continued share purchases by Naspers and Prosus, and the stronger e-commerce portfolio. I'll also show the charts with the discounts to NAV, and I'll show that those are slightly wider than the last presentation we did. Our hold recommendation is unchanged. We've got quite a cautious outlook on Tencent, and that's the primary reason for a hold recommendation. So just to go through the numbers, total economic interest revenue was flat. So this total economic interest revenue does include Tencent. Tencent's about 70% of this revenue, but that was down 4%, and the e-commerce portfolio up 13%. If you look at revenue on a consolidated basis, which excludes Tencent, that was up 10%, and that was driven by the classifieds, food delivery, payments, and fintech part of the portfolio. And then Prosus posted an operating loss of $546 million. It's a narrower loss than in the prior period, which was in excess of $1 billion. Then the main line item, which includes the Tencent results and some of the other listed assets, that it decreased 46%. And that was because Tencent made less gains on their acquisitions and disposals than in the prior year. Going down the income statement, there's also a line item for Prosus to record gains and acquisitions on its disposals. In the year, it did sell some of its Tencent stake, and the gain that they made on that was 33% lower than in the prior period. The gain was $5 billion, and in FY23 they made a gain of $7.6 billion. So as a result, the diluted EPS was 25% lower. HEPS and core HEPS were up significantly, but those numbers exclude a number of factors like the gains on the disposals. It's worth noting, and you may have read in the media, or if you watched the investor presentation, they speak a lot about the e-commerce portfolio reaching profitability. What's important to know is they're talking about a trading profit, which is a non-IFRS measure. If you include the corporate costs in trading profit, they actually made a trading loss of over $100 million. And the true measure of profitability is the operating income for the operating loss line item, and that's sitting at a loss of over $500 million. Here's the performance since our last report. So prior to this, Tencent had been underperforming Prosus and Naspers as their share prices were in decline. On the rebound, we suspected that Naspers and Prosus would underperform Tencent, just like you can see in this graph. Going forward, we expect like similar themes to continue, with Naspers and Prosus being less sensitive to any Tencent price changes. Here's the discount to NAV. It's widened slightly since our last report, but the discount has also narrowed slightly. And then when the discount is this narrow, like you can see it is here, our preference towards Naspers and Prosus becomes indifferent. And that's because management is incentivized to reduce this discount over time. And the more that either one of them is discounted, the more value per share you would get as that discount is unlocked. But at these levels, it's much of a muchness. For those of you who are unfamiliar with what you're buying when you buy Naspers and Prosus, this is a snapshot of what you're buying. So most of it is Tencent, and that's the blue. The blue is all the listed assets. There are some other ones in there, but Tencent makes up the majority of that. And then the smaller piece of the pie is the e-commerce portfolio. And by our valuations, we've got that's majority made up of the payments and fintech business, followed by food delivery. And then finally, just onto our valuation. Prosus, we've got an intrinsic value of 660 Rand. Naspers 3,400. We get here by applying some big discounts to the total value per share. As I said in the beginning, we've got a very cautious outlook on these stocks, given that they've got significant exposure to China, and we've got a negative view towards China. But if you've got a less conservative view, then you could probably apply a lower discount, and that may indicate some upside for Naspers and Prosus. I'll just quickly hand over to Sean for the technicals, and then we can take some questions.
Yeah, good morning, everybody. You can see the chart there of Naspers. This is yesterday's close. So you can see that Naspers, the share price broke out of that long-term sideways or trendless market way back in April. And since then, it obviously has pulled back now to retest what I call that resistance zone. And that's where it is trading at the moment. I saw this morning it's pulled back 1%. So it's pulled into that little zone at the moment. So the share price is still it's trading below its 21 and 40-day moving averages. I'm still calling the trend, the medium-term trend, bullish until those two moving averages, the 21-day crosses below the 40-day, and then we'll have a change in trend. Saying that also, as I say, the long-term trend is still bullish. You can see the 200-day moving average there, and that 200-day moving average is basically where the intrinsic value is at 3,400 level that Matt was alluding to now. So also in the short term, as I say, the share price has pulled back to that support zone. If it does break through that ascending support trend line, it could trigger a change in trend. I think it might pull back to that 200-day moving average. As I say, is the intrinsic value, and that could be a better opportunity to buy in at lower prices. But I also think at this point now, this resistance zone will act as a very strong support zone. So we might see a bit of a sideways market at this moment. Yeah, and as Matt said, now we still have a whole recommendation on this company. So yeah, the MACD at the bottom there shows you that it is just moved into oversold territory. It is trading below its signal line, so it is bearish on that indicator. So that's confirming that this recent pullback. So yeah, that's how I see the charts at this point in time.
Thank you, thank you, Sean and Matt. Yes, there. If you look at the right side of the chart there, just bring it back up. There's a couple of long red bars there, which suggest that the sellers aren't out of the way yet. So Sean's probably right that it's going to return and break through that resistance level and maybe come back to the 200-day moving average. As Matt has highlighted, there's some risk in China as well. So not certain what this is going to do. I certainly don't expect it to go back into the trading range, unless, of course, there's big trouble in China. I'm going to hop into the questions quickly. Let's see. Skulk wanted to know, I just want to see, I typed it in the chat here. He said, Skulk said, their core business question mark was still 10 cents. The rest of the stuff, you had a little pie chart there to show what the other businesses were. Matt, do you care to just highlight for us what's in that package that sits outside of the 10 cents? What kind of businesses?
Yeah, sure.
You said food delivery and that, but I mean, anything specific that we know?
Yeah, so what we would know is the Takealot, Media 24, but those sit within Naspers. If you own Prosus, then you don't own. You've got no exposure to Takealot and Media 24, but those assets are so small that they're basically negligible. We basically ignore those in our valuation. The e-commerce portfolio is made up of a number of different assets. They've got yeah, I mean, I wouldn't even know. If I could guess, I'd say probably 50 to 80 companies, and those are made up in. They classify them into food delivery. So they've got a number of food delivery companies, classifieds, payments and fintech. There's a lot of those, edtech. So things like online courses, and together that e-commerce portfolio makes up about 10% of the valuation. They've made quite a big deal about the e-commerce portfolio being profitable now, which, as I said, it's just by their own accounting measures. By IFRS measures, it's not profitable. And in fact, they actually they've got about $16 billion in cash, and they made more money from the interest on their cash balances than they did from all of these businesses together. So that's one of the reasons why Naspers trades at a huge discount to its net asset value. They're taking all the money that they get from Tencent and they're putting it into these smaller companies, some of which are doing well and some of which aren't. But as a whole, for a number of years, they've been loss-making. And so that's the box of licorice, all sorts.
Thank you. Alex says, when will this update report be uploaded on PSG? I suppose your report's already on its way to the online website, and the recording of this will take a couple of days, and then we'll post it on the YouTube channel, which is in the link on the invite, Alex. Then Clive says, thanks. There's a thumbs up. I suppose that's Alexander. Thank you. Then what do the long red bars indicate? Yeah, if you look at the chart there, the length of the bar actually indicates how much action there was in the day. So the longer the bar, it means between the high and the low, there was a lot of movement, which suggests, along with the spike at the bottom, if you see the red bars at the bottom right, there, those red and green bars, they indicate the volume that was traded. So those volumes were substantial. So it tells you that there's, not just retail investors, but specifically institutional traders involved in the stock here. And the guys that won, the reason for the bar being red is the sellers. So it started much higher and then closed lower. So the length of the bar sort of indicates the trading range for the day, and the color of the bar indicates what the price action was on that day. And the long red bars suggest to me that the selling trend is still, or the sellers are still out there. If you look just left to those long red bars at the top, you'll see there's a lot of bars with very small bodies. Those candles have very small bodies. So the share was actually very indecisive on that day. It opened up, went higher, came down, went lower, and then sort of closed where it opened. So the body of the candle is very small. But the moment the body of the candle starts to stretch, there's a lot of price action, and there's normally a single trend on that day. So red being starting high, finishing low, and if it was a long green bar, then obviously it would have opened low and finished high. I hope that explains. Vessel says, considering the high exposure to Tencent, why not simply invest directly in Tencent? I suppose you could do that.
So I mean, that's also another reason why it trades at a discount. If you did want, if you like Tencent as a company, you can invest in that directly, and then you don't have any worry about your any of the money that you get from Tencent getting allocated poorly to other assets. But it is, I guess, a nice way as a South African to list on the JSE and get exposure. So it just depends on individual circumstances.
Okay. Then Richard says, Sean, why are you using 21-day and 40-day moving averages, mate?
No real reason. I just think they're medium-term indicators, moving averages. Personal preference.
It's sort of, it's a personal preference, but it's also sort of accepted that the market uses 200-day moving averages to sort of have all the trading days in a year. And the 21-day moving average to at least have a month's worth of price action. If you think about it, there's about roughly 21 business days in a month. So that's it. And then some guys use a 50-day to measure the crossover between the two. You can shorten it if you've got a shorter time horizon that you're looking at, or a shorter time between trades. If you're a more active trader, then you'll obviously use a much shorter cross with that 21-day. But it's a matter of personal preference. The market standard's basically the 21 and the 200, which is indicates the monthly price action. So it averages that for you, and the 200-day averaging the annual trend, if you want to call that. So I hope that answers Richard. And then Clivey says, what's up next week? We're smoking, Clivey. It's British American tobacco. So we'll be doing British American tobacco next week. Let's see. Any last for the last? Nothing. Okay, great. Thanks very much for joining us today, guys. Thank you, Matt, for giving us your insights. We'll read the report when it's available there. Richard says thanks. Thanks, Sean, for your insight into the technical stuff, and we'll be getting together next week, same time, same place. Have a fantastic Thursday. Cheers, guys.
Thanks, guys. Cheers.